Exchange rates. Okay, here we go. You see this? This is money, which I'm not sure how much it is worth, but exchange rates tell us how much money is worth. So we have floating, we have fixed, and we have flexible. A floating exchange rate is an exchange rate that is dictated by the forces of demand and supply, whereas a fixed is one that is controlled by the government. So we have China controlling the Chinese yuan, and they try and depreciate it so that they can export more. The more they can export, the more jobs they can provide to their local economy. The US has technically a stable currency in comparison to many others, and that tends to appreciate. So hence they chronically import more than they export. Now, the mix between both, between a floating and a fixed, is called a flexible exchange rate. And it's when the government will intervene if the exchange rate is either too high or too low. And this helps businesses plan ahead, and it also helps businesses not suffer from a low exchange rate or a very high exchange rate. So, a couple of diagrams that are important for us are the demand curve. Now, the demand curve, downward sloping in this case, again, theoretically, we're assuming that here we will put exchange rate, so ER, and on the X we're going to put quantity for quantity. So at a high price, the quantity of exports is going to be low. So if the pound is worth, I don't know, $3, then the US is not going to be able to buy things from us. We're going to be way too expensive for the US. So our quantity of exports is low. Then if we have quite a low exchange rate, let's say $1 for £1, that's a fairly cheap pound, then we're going to be able to export more. The US is going to be able to buy more things from us. So we have a higher quantity of exports. So the demand curve is very much directly related to our levels of exports and imports when we're looking at the demand for the currency. So how can I put it? If the US demands more cars from the UK, we export medicine and financial services. So if they demand more cars and more financial services, then the currency will appreciate because they are demanding more. However, if the value of the pound is too high, then we won't be able to export too much. So that is the relationship. So it's a negative relationship between the exchange rate and the quantity. Therefore, a downwards sloping demand curve. We also have a curve, and it's the other one, the supply curve. We'll put it over here. And that is directly related with the level of imports. So if the pound is strong, so the pound is like $2 to a pound, then we're going to be able to import a lot of things from the US or a lot of things from China. So we have a high level of imports. So the Q is quite high. Whereas if the value of the pound is low, is $1, then we are not going to be able to import many things from abroad. So right now, for example, the value of the Argentinian peso is very low. So they can't really import that much. They might be able to export, yes, but they can't import that much. So that is the supply curve. And when the supply meets the demand, we have our equilibrium. And that is the balance between the demand for a currency and the supply of that currency. So we can, let's draw go. So exchange rate, let's say for the pound. So we have our equilibrium point here, QE. This is the exchange rate. Let's say at the moment is £1.28 US dollars. That is the current equilibrium. So with that, we have a certain level of exports and imports at that particular price. So, but if the price of the pound goes up, so it appreciates, the value increases, we can buy more US dollars with it, then two things will happen. One is, you can see the level of exports will decrease. However, the level of imports will increase. And we have this gap is created between both. And that I guess lack of balance will bring down the value of the pound, theoretically, because we have a higher level of exports compared to imports. Higher level of imports compared to exports. So we are the demand for our currency is low, and we are buying other currencies because we're importing a lot. So hence, that's going to push the value of our pound down towards the equilibrium. And the opposite happens if the value of the pound is too low. Let's say £1 is worth $1 US. So at that rate, we see that the quantity demanded for our exports is quite high, because it's cheap. The pound is cheap, so they're going to buy things from the UK because the pound is quite cheap. So for example, when they first announced the whole Brexit, the value of the pound decreased, and during those few months our exports increased because the pound was so cheap. However, eventually the pound gained some traction again, and our level of exports decreased as the value increased of the pound. So what I'm trying to say is, if the currency is weak or it has depreciated, it will encourage more exports, less imports, pushing up the value of that currency, because other countries will be buying our currency as they're trying to buy things from us. So as they demand more of our currency, more of the pound will increase in value. So that's the relationship with imports and exports. We have to bear in mind what we are exporting and what we are importing, because if it's something which is elastic, PED of 1 or more, then it is something which is competitive. And if we're exporting something elastic and our price is too high, then other countries will buy it from somewhere else. So that will depreciate our currency quickly. Whereas if we're exporting something inelastic, I don't know, maybe the vaccine for COVID, then our currency is going to be strengthening, and the appreciation in our currency is not going to weaken our exports, because the world will need what we have. And that happened in 1972 with the price of crude oil. There was a high demand for crude oil. As you know, we use it to run our cars, for energy, for plastics, for heating. So there's a high demand, and there were only a few countries that were extracting crude. So therefore they put the prices up, and the US and the UK entered a period of recession and inflation, because they had to pay high prices for this valuable commodity at the time, and they couldn't buy it anywhere else. So even if the value of the ruble, of the Venezuelan peso was going up, we couldn't get those crude oil from anywhere else. So that's an example. So another thing to bear in mind is the Marshall-Lerner condition. Let me Marshall-Lerner condition. So when we're looking at imports and exports, when we're looking at our current account, we can have a surplus if we export more than we import, or we can have a deficit if we import more than we export. So if you think about China, they're pretty much in a surplus. They export a lot in comparison to what they import, whereas the US will be on a current account deficit because they import more than they export. Now, Marshall-Lerner came up with this theory, and they call it the JCurve. The JCurve, why? Because there was a link between the levels of imports and exports and the value of the currency. So, but this only is applicable, or he said is only applicable if the elasticity, the PED of these exports and imports is elastic, meaning that it's more than one ignoring the symbol, ignoring the sign. So we're looking at things that there's a lot of substitutes for, and they're very much price driven, the demand for them. So what does that tell us? It tells us that if the currency is strong, if the value of the currency is high, then we are not going to be able to export. So hence, if we're not able to export, we're going to start entering a deficit. But because we are not exporting, and because we're importing, then the value of our currency, it's the more we import, the more our currency will devalue, the more it will weaken, the more it will depreciate. And it will depreciate because we are buying other currencies and nobody's buying our currency. So hence, if nobody's buying our currency, then the value of our currency will go down because there's no demand for it. And then as the value of our currency goes down, something happens. Eventually you'll reach a point where the products that we make become attractive for other countries. Take for example Germany. After the war, they had their currency was depreciated for a number of reasons. One of them being the high debt they had after the war, and that meant that they were able to export at a very low price. So Europe and the world started buying German goods because they were very competitive in price. So suddenly they started gaining this surplus because they were able to export a high number of goods. And as the more they export, the more demand there is for their currency. So you see this J-curve going first down because the value of their currency is too high and nobody's going to buy their products, to the point that eventually, because nobody's buying their currency, the currency depreciates so much that their goods become competitive on the foreign market, and other countries will buy their products. And hence, as they buy their products, the currency starts appreciating along with the demand for their goods. That is, in a nutshell, currencies for you. I wish you the best of luck and have a great day.